What if a company went from, losing millions to suddenly earning millions in just 9 months?
Right.
And what if that profit wasn't from selling coffee or energy, but from this sort of mysterious magic of valuation?
Welcome.
Today, we are unpacking a really fascinating report. It's the 9-month 2025 financial report of Verusaturk Girişim Sermayesi Yatırım Ortaklığı, or just VERTU for short.
And these kinds of companies, venture capital investment trusts, their reports can be, well, they can be a bit of a maze.
Exactly, especially with high inflation accounting thrown in. So our mission today is to cut through all of that complexity and give you, the investor, a clear idea of what's really driving their business.
Let's do it.
Okay, so let's first get to know the company a little, because I think understanding their structure is just key to everything else.
Absolutely. So they're headquartered in Maslak, Istanbul. They trade on the BIST main market.
As VERTU.
As VERTU, yes. And at their core, they are a venture capital investment trust. So their whole job is to invest money in high-growth companies.
And they focus on a few key areas, right?
They do. They've really zeroed in on three main sectors. You've got renewable energy, then technology and software, and that includes digital gaming, and finally, the food and retail sector.
What really stood out to me was the size of the team.
Oh, yeah.
The report says they have an average of only 4 core personnel. 4 people.
And that's the metaphor you have to hold on to. This isn't some giant factory. It's a small, very nimble command center.
A command center choosing where to deploy, massive resources.
Precisely. Their value isn't in making a product themselves, it's in their ability to pick the winners.
So who's control of that command center? Let's talk about the structure.
Well, their issued capital is 52 million Turkish lira with a ceiling of 250 million. But the real power, it sits with the parent company.
Verusa Holding.
Verusa Holding, exactly. They own about 63.6%. But here's the critical part, the A group shares.
The special shares.
Right. Those shares give them the right to nominate 2/3 of the board. So, control is very stable. It's locked in.
Which is great for strategy, but something for a minority investor to keep in mind, for sure.
Definitely. You're trusting their direction.
So let's see where that direction has taken them. Where's the money actually going?
It's pretty diverse. In energy, the big one is a 51% stake in Pamukkova Electric.
And that's their renewable platform.
It is. And this isn't just paper. We're talking about real physical assets. Hydroelectric plants, solar plants, a total of about 18.5 megawatts of installed capacity. It's a solid foundation.
But they're not just about hard assets, are they? They're big in tech.
Very big. They have a 60% stake in Vectora, which is a major SAP Gold partner, plus other stakes in firms like GoLive and Probel.
And the gaming part is just a great story.
It really is. They have a 50% stake in CoreEngage, a game developer, and their game, New Cycle.
It won Best PC Game Award 2024.
Exactly. That's the kind of validation that shows their picks aren't just gambles, they're backing real success.
And to balance things out, they have a consumer play with Kave Diara.
Right, a 50% holding in a national food and retail chain. It gives them a nice hedge.
So if we were to do a quick SWOT analysis, what's the picture?
Well, the strength is clearly that diversification we just talked about and the proven performance of their subsidiaries. Like that award.
And the opportunity.
It's huge, leveraging the growth in renewables and, of course, the whole digital transformation trend.
Okay, what about the weakness? There has to be one.
The main weakness is their exposure to volatility. Their value is tied to these private assets, so it's all based on valuation models, which can swing wildly.
And the threat.
Managing all of this in a high inflation economy. The report mentions cumulative inflation hitting 343%. That makes everything complicated.
That is an understatement.
Mm-hmm.
Okay, before we dive into those complicated numbers, if you're finding this breakdown valuable, please take a second to like this video and subscribe to the channel. And if you really want to support us, you can evaluate membership to help us keep making this content.
It really helps.
All right, now we can move on to our analysis. This is where we see how all those assets actually turned into profit.
And let's start with the big picture, the balance sheet. Total assets are up from 4.66 billion lira to 5.02 billion.
Which is solid growth.
It is. But here's the amazing part. Of that 5.02 billion, 99.2% of it is just financial investments.
So the company essentially is its portfolio.
Almost literally, yes. And their financial health is incredible. Shareholders' equity is 99.8% of their assets.
Wow. So they have practically zero long-term financial debt.
None. They are funded by their owners, full stop.
Okay. That's the foundation.
Mhm.
Now for the income statement, where, I mean, the real drama is.
It really is. So their revenue, or a hustlat, took a massive jump from about 700,000 lira to over 7 million lira.
And that's mostly dividends, you said.
Almost entirely. It's a great sign that the companies they invested in are starting to mature and send cash back.
A very positive sign. But it's not the headline number, is it?
Not even close. The headline shocker is the net profit. In the prior year, they lost 76.8 million lira.
A big loss.
A very big loss. And in this period, it flipped to a net profit of 376.8 million lira.
That's an incredible turnaround. What does that mean per share?
It means going from losing 1.48 lira per share to earning 7.25 lira per share.
So the obvious question is, how?
Yeah.
How does a four-person team generate that kind of swing without selling off their major asset?
Well, you're right. It wasn't by selling more coffee. When you drill down into the report, you find it. Almost every single lira of that profit comes from one line.
Let me guess. The valuation gain.
The financial investment valuation gain. A gain of 378.6 million lira. That is the entire engine of this profit.
And that gain reversed some huge losses from before, particularly in energy.
A huge reversal. Pamakova Electric, for instance, booked a 28.9 million lira gain this period, which erased a 578 million lira loss from the year before.
So for the investor watching, we have to be really clear on this point. What does a valuation gain actually mean in terms of cash?
It means this 376.8 million lira profit is overwhelmingly unrealized.
This is paper profit.
It is paper profit. It's management saying, this is what we think our companies are worth now. It's not cash that came in the door. And understanding that difference is just, well, it's everything.
So if it's paper profit, let's check the cash flow statement. What's the ground truth there?
The ground truth is they didn't really bring in cash. In fact, their cash on hand went down.
It went down.
From 2.5 million lira to just under a million. And their cash from operations is still negative, an outflow of about 39.7 million.
So they're still burning cash day to day.
They are, yes. It's improving, but they are still in that investment phase, spending capital to grow the assets. That's the normal life cycle for a VC fund.
And what were they doing on the financing side?
They spent 19.1 million lira on share buybacks, which is a good move for shareholders when you have no debt.
Okay, I also noticed a big jump in money moving between them and their related companies.
You're right. Receivables from their portfolio companies like CoreEngage and Vectura went way up, from 3.7 million to 26.6 million. And they took a small, short-term loan from their parent, Verusa Holding.
So a lot of internal cash movement.
Very active. It's common, but it's something you always want to watch for transparency.
Okay, so we've seen the dramatic profit turnaround. Now let's get into the fine print. How did they actually calculate those huge paper profits?
Right. And you have to start with inflation. The report uses TMS 29, the high inflation accounting standard.
Which is mandatory.
It is. So every number we've said, the profit, the assets, it's all been adjusted to the purchasing power of September 2025. Without that, the numbers would be meaningless.
It's necessary, but it does add another layer of abstraction for the investor.
It does. And that abstraction becomes really important when we look at the footnotes on fair value.
This is the key, isn't it?
Yeah.
Where that 378.6 million lira gain came from.
This is it. And here's the big takeaway for you, the investor. That profit is based almost entirely on what are called level 3 inputs.
Okay, so break that down. What is a level 3 input?
It's the most subjective kind of valuation. Level 1 is simple, like a stock price on the market. Level 2 is a bit less direct. But level 3,
That's their own internal models.
that's management's own assumptions and their own complex models. There's no public market price to check against. Those 4 people we talked about. They are building the models that say what the company is worth.
And they're using techniques like discounted cash flows.
Exactly. Projecting future income and then discounting it back. And the rates they use are very high, like a 30% WACC for their software investments.
Which means they are pricing in very high risk and expecting very high growth to justify it.
That's what it tells you.
There was one other detail in there that seemed incredibly important. The liquidity discount.
Yes. This is, I think, the most critical disclosure in the whole report for an individual investor.
So what is it?
When they value their private companies, like Vectura, they calculate the value, and then they immediately apply a 30% discount.
They knock 30% off the top. Why?
Because they're acknowledging that these shares are not liquid. They're saying right there in the footnotes, if we had to sell this company quickly, we would probably have to take a 30% haircut to find a buyer.
So that 30% is the real-world price of illiquidity.
It's a price of not being a publicly traded stock. It actually makes their valuation feel much more disciplined and grounded in reality.
It really does. Wow. So this has been a fascinating look under the hood. If this kind of deep dive helps you understand the market better, please, again, consider evaluating membership to our channel. It's what allows us to keep producing this content. And don't forget to like, share, and hype us up in the comments below.
Okay, so to sum it all up, VERTU had a huge profit turnaround.
Right, but it was fueled by rising fair value, not cash.
Exactly. The
Okay.
company is debt-free, it's diversified, but it's still in a cash burn phase. Its success really hinges on that small team's ability to value these very complex, illiquid assets.
So we've learned to look way beyond that big headline number. What's the final thought we should leave everyone with?
We've seen that the profit here is almost entirely dependent on these subjective level 3 inputs models based on future hopes, not cash in the bank today. So that raises a really important question for any investor. When a company's success relies on complex models hidden in the footnotes, what does that reported profit truly represent for your portfolio's real-world value? And, how much weight should you give to accounting gains versus actual cash generation?
That's a great question to think about for any investment. Thank you for sharing your source material with us for this deep dive. We'll catch you next time.